The S&P 500 closed 54 points lower today and broke through some important levels, and again showing some patterns that we saw in early 2008. So I'm going to kind of show how what this looks like compared to that time frame, as a lot of people feel like the market in 2019 will have a similar year. I'm not one of those, but there's that possibility that it could be similar to 2008. If it is, I'm going to show you how we compare right now to a low point that we had, to an area that we had there, with some signals that are showing up on the market forecast. We're going to stick in that healthcare sector for another trade idea today with some weakness that we're showing there. So let's go ahead and get started. Today is Monday, December the 17th, 2018. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's take a look at the S&P 500 with the market forecast indicator first. You can see the third consecutive down day, 4 out of the last 5. Would that be 5 out of the last 7? You add these two, right? 7 out of the last 9. Following market sentiment, following intermediate line. In fact, the intermediate line fell below 20, with both the momentum and near-term lines in the single digits. That is a cluster. That is an oversold cluster. Again, last time we had an oversold cluster was back here, October the 11th. A little bounce there before we hit that new low point. That was on the initial volatility surge. We got another extreme level of volatility here today. You'll see here in a second. If you take a look at the weekly chart, now the weekly chart's not over, but as of right now, it would take a significant move to the upside to avoid getting a oversold cluster on the weekly chart. Now, we didn't get one of those in early 2016, late 2015 on the weekly. We have to go all the way back to 2009 is the last time that we got an oversold cluster on the S&P 500. Now, if I were to go back a little bit further and change this to a weekly chart, so if we look back at the beginning of 2008, 2000, and when the bear market started back then. So let's zoom in a little bit, and then we'll kind of move over here. So there's the cluster. There's the first cluster we got during this bigger pullback. After we had the death cross and the bearish posture, we did bounce back up to the 200-day moving average at that point. It didn't get any further, and we eventually fell. But this was like in March of 2008. Remember, the stock market peaked in October of 2007, and then we fell from that level, from that high in October 2007 down to that oversold cluster. We fell almost 20% before bouncing back up. You can see 19.25%. So similar move. It's interesting. I said earlier this year, I said quite a bit actually earlier this year that the foreign stock markets were looking so bearish, like the Germany especially, and Japan too. But if I were to zoom out on this, on Germany, even if you account for, like, here's everything pulled back, but then remember the S&P took off here. So while the S&P was taking off, Germany was falling, and so by the time we got to the beginning of October, when everything fell, Germany had already had 13, 15, almost 14% decline before this triangle that broke back down, that continuation, and that broke down to the downside when the S&P broke down too. I mentioned back then, and you remember the S&P was actually up from that standpoint, from what would be April the 18th to August the 15th. If you look at the S&P, April the 18th is right here. So there's April the 18th, and then August the 15th would be right in this area. So, from this peak to that low point, the S&P was actually up. But Germany was down, almost 14%. And I mentioned then how, if the S&P 500 was down, this is the biggest economy in Europe. The fourth biggest economy in the world, and China and Japan are showing similar patterns. If the U.S. was down 13%, people would be going crazy. Here we are. We are down 13% from that high point, and people are going crazy as if the market's going to start this big bear move. And if I were to go back to Germany, from its peak here earlier this year, when everything peaked, Germany to its cluster today is down 29%. 29% if you look at SPX, from its same peak here to now, it is down 11% from that peak. A little bit more, a little bit higher from this peak. So you kind of get an idea that a lot of this is catch up with what we've seen globally, and that's just in Germany. Remember, if you look at like Japan and you zoom out on Japan, you see a similar pattern, right? From May until September here. So if I were to draw the same line from that peak down to this low point, even to that low point where we had the cluster, I mean that's an 8% decline off of those lows, and when the S&P was rallying. You look at China. China was well off of its highs. By the time we got to early October, when things started to falter, we're down 17.5%. This is the world's second biggest economy. You look at other like France. You look at France from its peak that it had here to its low point. Down to this low point here, down 10%. And again, the idea being that if the S&P ever falls double digits like that, again, people go nuts, and that's what we're seeing right now. We're seeing a big increase in investor sentiment on a move that most of the global markets have already seen this year, and now this has just exacerbated it. Whereas for the S&P, this is 13% drop. It's and if you put it in perspective here, and let's take a look at the next chart. You put that move into perspective, you can see off of the 2016 low, last time we had this death cross up till now, basically it's a 38% retracement of the significant move off of that early 2016 low point. Would be what, from this area here all the way up to this high point that we had in October. It's a 62% gain. That's a 23% annualized return over the course of 952 days. That's almost 3 years. What would that be, from early 2016? 2+ years, 2.5 years. That's a pretty decent return for 2.5 years. And so now we're getting a little bit of a pullback. We saw the same thing before that, right? You zoom out here. Let's go back 10 years. There's the rally we had off of the death cross in 2011 up to 2015, and we pulled back to 23% retracement during those death crosses. So we're getting a little bit deeper of a retracement here, which happens to be about 38%. If you look even before that, off of the 2009 low point here, 2009 low right up to there, you can see we had a 38% retracement during the 2010 death crosses, and then from the 2010 low up to that peak, you can see a little bit more of a pullback in 2011. In fact, if you were to go from the 2009 low all the way up to 2011's peak, you can see a 38% Fibonacci retracement during that significant pullback there. So you can see how these Fibonacci's work on a long-term level, and as of right now, we are pulling back. After an extended run of 20% a year plus, we are in the process of pulling back here towards Fibonacci retracement areas. And it's producing clusters out the wazoo. I mean, you look at you have a cluster on the S&P 500, you have a cluster on the Dow Jones Industrial Average, you have almost a cluster on the NASDAQ, you have another cluster on the Russell 2000 with the market sentiment. Remember how rare that is. Again, the weekly charts, you can see multiple weeks of clusters on the Russell 2000, multiple weeks of clusters on the NASDAQ Composite, which we haven't gotten in a very, very long time. Again, the last time we've had multiple weeks of clusters was at the market low point in 2009. And again, if I were to go back a little bit further on this, to look at the beginning of the bear market in 2008. Here we go, right in here you can see we did get multiple clusters there again in the beginning of '08 that led to that return move back up towards that 200-day moving average, and then the next series of clusters set the low point that we've been riding up off of ever since. You can see too, like the S&P 500, this rally that we've had up to look at all the overbought clusters we've had. We are now sitting at 38% retracement of the move off of those 2016 low points. And a reminder, on all these weekly charts, anytime you get reversals, it almost always has long lower shadows. And again, long lower shadows in weekly charts mean Monday and Tuesday are really bearish. Before, you can see if we were going to get, if this is where the open is at 25.90, then we hit a low point today of 25.30. That's going to be a 60-point long lower shadow if we rally by the end of the week and produce a long lower shadow. That's how long the shadow would be, the size of the candle currently. If you take a look at the 3 green arrow chart, you can see that we have obviously 3 red arrows. If you take a look at it on a 2-line basis here, there's your MACD and your stochastics. Again, how far away are we from the 30-day moving average and the 8-day moving average? If I change the MACD to the current price, and we'll take first a look at the 8-day moving average here, that kind of gives us an idea how far away we are. It's pretty significant here on an absolute basis. And you take a look at how far away we are from the 30-day moving average. From the 30-day moving average. So let's do this, and we'll change this to a simple and change that to 30. And there we go. Again, only this period right here was deeper, and we obviously can form a divergence with that low point, with a higher low point here. And the same thing in the stochastics. You see the stochastics still setting up for a significant bullish divergence pattern with how significantly low we are right now to this low point here at 25.30. You can see a significant low because, again, closing below these long lower shadows. That's the first close that we've had below these levels. And you can see this low point, 25.32, we are very, very close to closing below that one. And that's a significant support that we did break below briefly here. So, are we going to close back up above this low point here? This 25.83, that's going to be an important development by the end of this week to see how significant of a breakdown this actually is. If it ends up being a fake out and right before this Fed meeting, or if it is actual breakdown. So another interesting thing about today's move, you can see again the high point is at 28.40, the low point is 253.53, so it's 26.87. We are just about at the 10% mark of the high. That's a significant extreme range. Obviously, well below last week's low point, lower high and a lower low compared to Friday's, finishing at the low of the day with a little bit of a bounce at the very end. If you take a look at the volume and the trading range on SPY, and we did have a little bit of a gap, but we filled it in. The close 260.47, the high today 260.65. So we filled in the gap. So the range was truly 7 points today. So a little bit over 7 points. And then the volume, you can see 165 million. So if you look at that in comparison, 165 million is well up here, way off of the range. 7 points is off the range too. And it's actually above 2%. Remember, 2% is actually going to be about 5 points, 5.5 points. So we're well above that 2% mark. Again, when you're looking for bear markets to start, if you go back all the way to 2007 again, let me go, let's say I need to go here, and we'll go to a daily chart there, and zoom all the way out here to 2007, 2008. So there's your the early 2008 when we broke down after peaking in 2007. That breakdown got your ATR up to 2.5, right around 2.5. ATR relative to price. So that's, we got above 2%. That's what started the bear market. And of course, we got the clusters and made the return move. But that's why I say it's so important. We also had a significant drop here that got us up to about over 2.5. And then in 2011, you can see how bearish it was. We actually got up close to 3% there. We were very, very close to a double dip recession before Operation Twist and QE3 kept it away, held it at bay. And then again, 2% on both of these did not lead to a bear market. And then of course, earlier this year at 2%, and so far at 2%. So we'll see if we continue to get, over 6-point ranges day after day after day, then that's going to pump this up above, up to that 2.5% mark, and potentially set the low point for a new bear market, right? Otherwise, we've seen this before play out earlier this year. We've seen this before play out in 2016. Fibonacci retracements on long-term levels lead to solid support levels. So to summarize, the markets continue to show extreme oversold conditions outside of linear regression channels, 3 standard deviations from the linear regression trend line. We see a lot of oversold conditions across other technical indicators, including rare weekly oversold signals that we just haven't seen since 2000, this whole bull market since 2009. And then when we did see them at the beginnings of that bear market, it actually set the low point for the initial stages and set up for a return move back to the 200-day moving average. Now, we could actually make a return move back to the 200-day moving average pretty quickly because we're not as far below it right now. And if we do make it by the end of this week, considering what's on the docket this week, then it'll be interesting to see what effect that has. Again, staying below the 200-day moving average, it means we'll be kind of in this mess for a while. But bouncing right back to it or a little bit above it would suggest that again we're trying to figure out a low point here and making a move back up towards those highs. So that's kind of where we're at to see how we finish this week with a lot of risk events on the table that can impact where you got the government shutdown by the end of the week. You've got trade data. Remember, they're supposed to by the end of this year and into next year have a little bit of a pause. So that's always going to be a constant. But the GDP, the FOMC, and the government shutdown things, those are all headline risks. As we know, this market right now is driven by headlines more than anything, and U.S. investors, more so than it seems like any other investors globally, are more prone to bouts of craziness when we get these kind of declines. What we're seeing now, other people all across the world have already seen this year, and have figured it out. Now, granted, they're still on their declines, and they've got wrapped up in the selling in the U.S., but it just kind of shows that the U.S. markets, this bout of volatility basically is the U.S. markets catching up to the international market, similar to what we saw throughout most and by the end of 2015. So what do you think about that? Do you agree with that assessment? Do you disagree? There's a poll popping out in the top right corner of your screen. Click that poll and either hit agree or disagree. If you click disagree, scroll to the bottom. Love to hear your thoughts and comments, what you're seeing that you can share with our Market Scholars community. All right, now let's take a look at what's driving the market here. And a lot of it, obviously, let's take a look at the asset class comparison. We'll just look at today only. So let's bring that up here and put that at 10 minutes. All right, there's today, and of course, there's your risk-off asset classes, long-term bonds and gold up here. You can see the dollar was not up. Emerging markets actually started the day in the bullish territory, and so did developed markets. So international stocks were doing okay. They eventually got dragged down. And again, look who's the biggest. Again, it's not getting a whole lot of crude oil is not getting a whole lot of credit for a lot of this decline that we're seeing in risk appetite in the U.S. If you take a look at, go back to again the peak, and we'll go to daily chart here. Crude oil is down 34%, or at least the ETF that tracks crude oil is down 34% since the market peaked You can see the market's down about 13%. Small caps down more than that. Developed markets, emerging markets, despite crude oil being down so much, commodities being down, emerging markets are actually holding up pretty well. Remember, they had big losses already this year. And you can see the U.S. dollar and gold both rallying along with long-term bonds. A very, very risk-off type of a move that we've seen throughout the last couple of months plus. Today that's what we saw. We saw gold up, we saw long-term bonds up, and on the 7 to 10 year as well as the 20-year plus. There's some mortgage-backed securities, municipal bonds. The dollar was not up today, so one of those safe haven asset classes not doing so well. There's high yield underperforming investment grade bonds. They were up today. There's developed markets outpacing emerging markets, commodities. There's your commodities, the S&P 500, mid caps, small caps. There's your growth stocks and value stocks and dividend stocks, all declining here pretty sharply, along with crude oil and real estate. So pretty much all asset classes across the board saw some kind of selling at some point in time today. So if you take a look now at the foreign markets and how they've performed, so we'll pull that up here and bring up the foreign markets list. You can see India continuing some relative strength here recently, but that's about it. Everything else down. There's China. There's your U.S. markets, emerging markets as a whole, the S&P 500, Canada down 2%. But look at the European markets continuing to show relative strength. I mean, they're all down, but in Germany's forming an oversold cluster, UK forming an oversold cluster, Canada forming an oversold cluster, Japan also forming an oversold cluster, all at their 3-month low points here in doing so. But you can see Italy's trying to base, France is trying to slowly base, Germany's trying to figure things out. They're all below falling moving averages except for a few here. You can see China's moving average is starting to roll over, so it will be red tomorrow. Same thing with Korea. But India is up above a rising moving average. So that's in fact, it's one of the only countries that's showing a bullish intermediate posture and trading above a rising moving average. Everything else is either bullish with falling moving averages, so they won't be bullish for long, or all their intermediate postures are bullish. And you can see Japan's below 20, Germany's below 20, US is below 20, UK is below 20, France is darn close, Canada's below 20. So it's again, we've caught up to the rest of the world, and there's a kind of a broad risk-off move except for a few areas. These are the 12 largest economies. The next 11 largest economies are this next 12 grid here. And you can see most of these are also declining, but not all of them. There's Indonesia up above a rising moving average with a slight pullback there, and a few some of them at their lows. You can see them all across the board here. Argentina, there's Spain and Australia up there at their lows. Look at all the clusters Mexico has gotten over the last oversold cluster that's gotten over the last 3 months. So again, S&P kind of catching up to the weakness that we've seen all across the board. There were a few economic indicators that came out today. The Empire State Manufacturing Survey dropped down to 10.9, so below the average, the estimates. You can see one of the lowest numbers we've had in quite a while. I mean, you have to go back to early 2017, right after the new administration came in. Since then, it's been doing really well, but this is kind of the first drop, about half of what it's been getting here lately in the 20s. And then the home building sentiment survey fell to 56, one of the biggest drops that it's had in a long, long time. A lot of it related potentially to tax reform and how that impacts these state taxes and being able to write them off. Treasury International Capital slightly positive. That has to match the trade deficit in order to balance the accounts, and it's pretty darn close. Not quite in the 40s there, but pretty darn close. Still positive. And then you can see the rest of the week we have housing starts, we have existing home sales, and the Fed meeting on Wednesday. Thursday you have the Philly Fed, which is another major manufacturing survey, and the end of the week ends with options expiration. You have corporate profits, personal income outlays, consumer sentiment. This would be the initial consumer sentiment. You also have durable goods orders. So you have quite a basket of economic data this week. A lot, and like I said, the potentially government shutdown by the end of the week. That makes for a lot of headline risk. So it's interesting with the biggest headline risk coming from Wednesday in terms of what's the Fed going to do. If you take a look at the where did it go? The interest rate hike odds here for December. What are the odds now that we'll get a hike in December? Well, they've fallen below 70%. It's crazy how the market's still pricing in that rate hike this week, but it's not a guarantee. Usually that's around 90+%. And if you look at March, it's all the way down to 20% now that we'll get another rate hike in March, and that's significantly down from where it was. Again, that would be the gray line down to 20% now. So down to this line, it was close to 60% right after the September FOMC meeting. We had jumped close to 60%. So the market was pricing in, but the market started to fall in October, and the odds, the expectations for that rate hike now are close to nothing, close to not having one at all. In fact, it's almost the same odds that we won't get a hike in December or March, right? So the odds that we'll get a hike in December and not in March are almost the same as not getting one in either month, right? Of course, the more likely scenario is we do get one in December, which is this one, but then no rate hike after that. That's appearing to be more and more the biggest odds that we have right now. Though even it's not a guarantee, right? Because this would be for March, and even the odds of getting a rate hike in December or March, just the one, are not even 60%. So again, that kind of shows how big of a question mark we have going into the FOMC this week, and that's going to have a big impact on whether or not we get another long lower shadow with the early weakness we're seeing early this week coming out of that meeting by the end of the week. And the GDP estimates will continue to be updated throughout the week here. It'll be updated again tomorrow. But right now, for Q4, despite all this weakness and despite economic indicators in the negative right now relative to their estimates, still some pretty decently high GDP estimates for this really negative quarter that we're having from an equity sentiment standpoint. All right, now let's take a look at the industry. Remember, this is the industries here are ranked according to the sector selector rankings that's been updated over the weekend. You can see the big declines. Look at the big declines we have in utilities and real estate. You would have expected, with those dropping as much, you would have expected a big jump in yields. Remember, we didn't see a big jump. TLT was one of the biggest performers. So interesting to see utilities, real estate, and staples all dropping hard today. Those are three of your biggest losers. That's not typical pattern on a decline, right? When we're having such a big decline, you can see communication services, technology, discretionary, all at 3-month lows. Healthcare pretty close. It's had a pretty sharp decline over the past week plus. You got some oversold clusters in the financial sector, the material sector, the industrial sector, and the energy sector. So the four worst performers are all showing oversold clusters right now, and you can see where the intermediate lines are for the ones in the middle, all around 20 to 30. You still got really, that you're basically coming down to the moving average on utilities. So you still got some pretty decent strength there. Everything else down below falling moving averages, similar to what you're seeing on the broad market itself. And even real estate, staples already is, but real estate more likely, depending upon whether or not we reverse this pretty quickly this week, this move, more than likely it's going to also turn, the moving average is going to turn red, turn over and turn red as well. But again, not typical to see a S&P down 2% and 3 of the 4 sectors you have that have underperformed would all be your quote unquote safe haven areas, whereas your outperformers were, your 4 worst performers: materials, energy, industrials, financials. All these 4 at the bottom of the barrel were all fell the least. Now they still fell pretty decently, so it's not like they rallied, but they fell the least. So kind of interesting to see the change that we're seeing there. Again, here's your, let's go to the comparison for the sectors. We'll go here. I keep hitting the wrong one, don't I? This one. So one grid, and then we'll also change the time frame here to October the 3rd. Since the market peaked up till now, we'll do it on a daily chart. Again, you can see the energy sector, the industrial sector, material sector, financials. I mean, they've all been the worst performers during this pullback. Energy down over 20%. And you can see the declines that we've had in real estate and staples, and why they declined as much today, because before today they were all above. They all had gains since that October the 3rd peak in the market. So it kind of shows that not everything has been on a decline. It's been these really weak performing areas that are all kind of dollar related. If you take a look at the dollar, energy, materials, industrials, especially as the dollar rallies, see the dollar's rallied from that October 3rd time frame, from right about there. We've had a decent rally. I mean, not up to significant new highs. In fact, you can almost argue that it's forming a little bit of a divergence pattern there. And it's still in the Fibonacci retracement zone of this negative move that we had when emerging markets and all those areas did really well from 2016 on, especially in 2017 into early 2018. All those international stocks really taking advantage of this weakness in the dollar. So we're still in the bouncing off of that in the Fibonacci retracement zone, and we'll see any kind of rollover there would point to continued outperformance in these areas: energy, materials, and industrials. The yield curve here data was updated for Fridays, and you can see the purple line is the 2-year, the black line is the 10-year. You can see it had bounced last week a little bit. In fact, if you kind of go on a week-to-week basis here, last week up until this week, or this would be last week's candle, we had a little bit of a bounce in the yield curve after really dropping from October all the way down. And the drop in the yield curve from early October now wasn't because the purple line was rising. It's actually kind of flat here, which again suggests the Fed may be pausing, at least according to the markets. But you can see the impact the economic growth, falling economic growth expectations is having on the long-term bonds, which are all falling. We've seen that before when the Fed stopped raising rates in 2006. They kind of fell back towards the short-term rates. Here I'll show you again. In 2006, 2007, I have to go back a little bit further, don't I? Go to weekly chart here. So here's 2006, and you can see how once the Fed stopped raising rates, these long-term lines all dropped after they did that, down towards the short-term yields. We had a little bit of an inverted yield curve then as well after the Fed stopped raising interest rates. And remember, the stock market peaked here in October 2007. So that's how much the yield curve jumped by the time the stock market peaked. And you can see why it jumped, because the low end really started to fall, the short end a lot faster than the long end. And so you had a jump in the yield curve. So interesting to see that kind of a pattern develop before a recession starts. Right? The recession doesn't start with an inverted yield curve; it starts after it, and there's a significant lead time too. And there's a pattern that will develop with a rising yield spread before the recession starts, when the stock market hit its peak. And remember, when the stock market hit its peak, commodities didn't peak until here. In 2008, in the summer of 2008, that's when commodity prices peaked. So you can kind of see the late stage, how the late stages of a cycle work there. Okay, there's a lot of stocks today that show some weakness in some of these safe haven areas, and following the theme we had on Friday, another healthcare related stock that's showing some weakness is Merck. You can see it breaking below, it's been riding a decent bullish trend here, but starting to break down a little bit below into the lower half of the Bollinger Band range, which we haven't seen here for a while. Take a look at like the DMI for Merck. You can see this negative line crossing up above 25, then the positive line crossing below 20. So it's a bearish development there. When you look at the other DMI indicators that go along with it, red arrow with a red histogram, bearish patterns as well. Market forecast indicator for Merck has been showing bullish posture, but the most bearish short-term sentiment that we saw since back here. Now we did rally off of that, especially with the earnings that we eventually saw, but we don't have earnings coming up here until after January expiration. You do have the potential, a lot of times when you get 3 red arrows here like we have, 1 today, 2, 3, a lot of times that's your, for trend trades, that's your signal to move your stop order. So there's a possibility we can bounce off of that, and but we're going to look for a bearish trade here. You can see it's been a really good stock. We're not going to be significantly bearish, but considering the market's posture right now, we're going to see if we can't take advantage of it, kind of staying towards, this really strong momentum, at best kind of flattening out, and slowing that momentum down, bringing this long-term line down. Again, a quick, easy trade before January expiration would be the sell, the 30 delta. Would be 77.5 by the 80. That gives you enough credit. You need to at least have at least 60 cents, 58 cents exactly, to get a 30% return on risk. So we're getting enough credit there, decent odds of success, and that blue line is the break-even point. So if I go back to the Bollinger Bands for Merck, you can see it's got to get back up above these highs, and you remember that's I'm able to take a $68 loss. So that puts us up to about right into that area, about 78 in this area here. So you throw that onto the charts. Here we go. There's where your break even ends up being. So you'd have to get past that for us to then exit the trade. So again, a way to take advantage of the bearish posture in the markets in a sector that has been relatively bullish, but now is starting to show some signs of weakness relative to its peers. So again, that wraps us up for tonight. Now I want to hear from you. Use that link that's popping up there in the top right corner of your screen to go participate in our Market Scholars forums, particularly the Market Outlook forum there. You can also comment down below, but I want to hear your thoughts, any questions or comments on what I talked about, any questions or comments on something or a pattern that I didn't talk about in tonight's videos. You can post those there. Again, thank you for watching. Remember to subscribe to our YouTube channel, click the thumbs up icon, and comment down below. Follow me on Twitter for more content throughout the week, and join our community that we created on Facebook for the Market Outlook videos. Again, have a great rest of your evening, everybody, and we'll see you all tomorrow.